In this session, we are going to discuss the techniques of evaluation of capital budgeting proposals. Broadly, we divide the techniques into two categories, that is traditional technique and modern technique. The traditional techniques are also called undiscounted techniques or unsophisticated techniques. And the second techniques are modern techniques or sophisticated techniques or discounted techniques. First, we discuss about traditional techniques, old techniques. The traditional techniques are two, that is payback period method, PBP, and the second one is average rate of return. First, payback period method. This is very simple method in which the payback period is the time duration required at which the cumulative cash inflows will be equal to cash outflow. So in other words, we can say the payback period is the time required to get back our initial investment. How much time period we require to get back our investment, that is called payback period. It's very easy to understand. कितना टाइम लगेगा हमारा पैसा हमको वापस आने के लिए, that is called payback period. This is very simple method, widely used method, widely recognized method, old method of time duration required to get back our investment. This is the meaning of the term payback period. Now we'll move on how to calculate the payback period. There are two methods of calculating the payback period. The first method is formula method. By applying a formula, we can find out the payback period. This method will be applied when annual cash inflows are constant. If in a project the annual cash inflows are constant, we apply a formula to calculate payback period. The formula for calculating payback period is PBP is equal to initial investment divided by constant annual cash inflows. By applying this formula, we can find out how much is the PBP. Let us take a simple example. Suppose an investment requires a cash outlay of rupees 1 lakh. 1 lakh rupees is the initial investment, and we expect that every year we can get a cash inflow of 25,000. So 1 lakh rupees is the cash outflow and 25,000 rupees constant is the cash inflow. So we simply divide 1 lakh divided by 25,000, we'll get 4. So payback period is 4 years. This formula can be applied only and only when cash inflows are constant. The second method is when the cash inflows are not constant. If the cash inflows are fluctuating, in that case for calculating PBP, we calculate cumulative cash inflows. Cumulative, one column we open cumulative cash inflows. Now we locate in which year the cumulative cash inflow will be equal to cash outflow, will be equal to the initial investment. That particular year will be the payback period. This is the simple method of calculating the payback period. Now, how this payback period method will be taken as a decision criteria to accept or reject a project? It's very simple. We calculate the PBP of a project. This PBP of the project will be compared with the standard payback period given by the management. If the actual PBP of the project happens to be less than the standard payback period, we accept the project. If the project's PBP is more than the standard, we reject the project. Example, if the management says we accept any project whose PBP will be 5 years or less. 5 years or less. This is the standard PBP given by the management. Now we compare the actual PBP. If the actual PBP of the project happens to be 6 years, we say reject this project because it is more than the standard. Similarly, if we have 2 or more than 2 projects, ranking is to be given. The project which has the smallest NPV, lowest PBP, that will be given first rank, and so on till the longest PBP will be given the last rank. Like this, ranking can be given for PBP. Now we'll come to what are the advantages of this payback period method. The first advantage is it's very easy, it's very simple, easy to calculate, simple to understand, and apart from that, it focuses or emphasizes on the liquidity of the problem, because it will be better as soon as we get back our investment. Liquidity is the main criteria of applying this method of PVP. Secondly, as the future is completely uncertain, it is always better to recover the amount as soon as possible. So this method is favorable. These are the advantages of PVP. Now, what are the limitations or disadvantages of PVP? The first disadvantage of PVP is it does not consider the time value of money. The PVP treats today's money and future money both are same. But in reality, the value of money will change from time to time. Today's money is much more worth than the future money. So we cannot compare cash outflow with cash inflow directly, because cash inflow we are going to get in future and cash outflow we are incurring now. So it is uncomparable. So this is the main drawback of PVP. It is treating the money as same. Time value of money is not considered. Similarly, the totality of the cash inflows are not considered. This method is considering the cash inflow only up to payback period. After payback period, the cash inflows are not considered. So this is not a true method. We have to consider all the cash inflows. Thirdly, the timings of the cash inflows are also not considered. For example, two projects are there. In these two projects, in A project we have a more cash inflow in the initial years. In B project we have more cash inflow in the later years. Both the projects may give the same PBP, but the timings of cash inflows are different. Magnitude of cash inflows are different. So these are the limitations, drawbacks of applying this payback period. One variant of this payback period is discounted payback period. In discounted payback period, we consider the time value of money. In this case, the cash inflows are discounted by a required rate of return, by discounting factor. So we bring down the future cash inflows to its present value, and then we find out the cumulative cash inflows. So this discounted cash inflow is a little bit, discounted payback period is a little bit better than normal payback period. So this is all about payback period. Now the second technique is average rate of return. Average rate of return. Second traditional technique. Average rate of return is also called the accounting rate of return, because the data required for ARR method is accounting data, not the cash flows. So this accounting rate of return shows, ARR shows what is the rate of return on an average we are getting from the average investment. There is ambiguity regarding the formula of ARR. Different authors have given different formulas for calculating ARR. The common formula for ARR is average accounting profit or average profit after tax divided by average investment into 100. The formula of ARR will be like this. ARR is equal to average PAT, profit after tax, divided by average investment into 100. So it's very simple. Simply we have to find out the average PAT of the life of the project. प्रोजेक्ट की जो लाइफ है उसका एवरेज प्रॉफिट आफ्टर टैक्स मालूम करेंगे, उसको डिवाइड करेंगे एवरेज इन्वेस्टमेंट से इनटू 100. दिस विल गिव यू द एवरेज रिटर्न वी आर गेटिंग थ्रू आउट द लाइफ ऑफ द प्रोजेक्ट. This ARR, how to take the decision? What is the decision criteria according to ARR method? We compare the actual ARR with the standard ARR or the required rate of return given by the management. The management says we'll accept the project if the project generates not less than 15% return. So this 15% is the standard rate of return given by the management. Normally it is the cost of capital. Now we calculate ARR and decide if the actual ARR is more than the required rate of return, accept the project. If the actual ARR happens to be less than the standard ARR, reject the project. In this way decision will be taken. Now how to calculate this average PAT? Suppose the life of the project is 5 years. So we calculate the total profit after tax of 5 years divided by 5. We'll get the average PAT. Suppose if the PAT is constant, if the profit after tax is constant, so instead of average, we take the same amount, same PAT, annual PAT will take a numerator. Average investment means the average of the investment, depreciable value of the investment. So to calculate average investment, we apply the formula like this. Average investment is equal to half of depreciable cost. Depreciable cost का मतलब will take cost plus installation minus scrap. Then after this we add up the scrap value. We add up the scrap value. In this way we calculate the average investment. Now, what are the advantages and limitations of this method? The first advantage is, again, it's very easy because only by applying the formula we can be able to find out the ARR. Second advantage is there is no complication of calculating the cash inflows. We simply take the decision on the basis of accounting profit. Third advantage is we take the totality of the profit. Unlike payback period, we have confined only up to payback period. Beyond the payback period, we have not taken into consideration. But in ARR, we take all the returns throughout the life. These are the advantages. But the limitation of this ARR is, first one, time value of money is not considered. This method considers today's money and future money, both are same. First drawback. Second drawback is, this method is based on accounting data rather than cash flows. And we have already seen that cash flow has an edge over accounting profit. Better criteria is cash flow, not accounting profit, because there are many ambiguities attached with the accounting profit. Non-cash items are there. So this method, this ARR method is also suffers from number of limitations. These two techniques, PBP and ARR, are called the traditional techniques of evaluating capital budgeting proposals. Now we'll move on to modern techniques or discounted techniques. This DCF, discounted cash flow techniques, are those techniques which considers the time value of money. This technique says today's money and future money are not same. In order to make comparison, we should bring down the future cash inflow to its present value by discounting at a certain rate. By discounting at a certain rate. So this method will have an edge over traditional methods because the drawbacks of traditional methods are overcome by these methods, by these modern methods. Right? And secondly, the totality of the benefits will be considered in this modern method. Whereas in PBP method, we are not considering the total benefits. Now, first modern method is net present value, NPV. The most accepted method, widely used method in most of the organization is NPV. The net present value is the difference between the PV of cash inflow and PV of cash outflow. Simply we take the total of present value of cash inflows. From that we subtract present value of cash outflows. So how to calculate the present value of cash inflows? Two methods are there. If the annual cash inflows are constant, we multiply constant annual cash inflow with PV, present value of annuity factor. Present value of annuity factor we multiply and then we'll get the PV of cash inflow if it is constant. If it is not constant, we open the columns cash inflow column, PV factors column. Multiply the cash inflow with PV factor to get PV of cash inflow. Take the total of PV of cash inflow minus PV of cash outflow, we'll get the NPV. Now what is the decision criteria for calculating this NPV? If the NPV is positive, accept the project. If the NPV is negative, reject the project. If the NPV is zero, indifferent, either accept or reject, does not make any difference. So in this way, decisions will be taken under NPV criteria. So comparatively, NPV supports are consistent with the objective of financial management. If the business resorts to NPV method, then definitely the objective of financial management will be achieved. That objective is maximizing the wealth of shareholders. Now, what are the advantages and limitations? The advantages of NPV method is, first of all, it is considering the time value of money. Most important advantage. This was not there in traditional techniques. Time value of money is considered. It is treating that today's value is much more than the value of future. So we have to bring down the future cash inflows to its present value, and then we can be able to compare the cash inflows and cash outflows. Secondly, totality of the benefits will be taken into consideration. The total benefits throughout the life of the project will be taken into account. Thirdly, it is consistent with the objective of financial management. By applying NPV, the wealth of the shareholders will get maximized. So these are some of the advantages. But the disadvantage of this is the calculations will be little bit more. More calculations are applied. Secondly, a correct discount factor should be used. If wrong discounting factor is used, then definitely we will not get the advantage of NPV. The result of NPV will not be dependable. So these are some of the limitations of NPV. Next comes profitability index. This is the variant of NPV method. The profitability index is also known as benefit cost ratio, B/C ratio. Benefit cost ratio. In case of NPV, we have taken the difference between PV of cash inflow and PV of cash outflow. But in case of profitability index, we calculate the ratio of PV of cash inflow divided by PV of cash outflow. We'll get a ratio. In other words, the profitability index shows how much return we are getting for every 1 rupee of investment. For every 1 rupee of investment, how much return we are getting. Suppose if the PI comes to 1.5. If the PI calculated comes to 1.5, it means for every 1 rupee of investment, we are getting 1 rupee 50 paisa of inflow. In other words, 1 rupee of outflow will give you 1 rupee 50 paisa of inflow. This is the meaning of PI. Normally what will happen, if a project has positive NPV, that project will have PI more than 1. So before that, first we discuss how the decision will be taken by calculating PI. If the project PI comes to more than 1, accept the project. If the PI happens to be less than 1, reject the project. If the PI is exactly equal to 1, indifferent, accept or reject. Like this we take the decision. So when we will get more than 1, when we will get PI more than 1, when PV of cash inflow is more than PV of cash outflow. In other words, when NPV is positive, we'll get PI more than 1. Similarly, when we'll get PI less than 1, when PV of cash inflow is less than PV of cash outflow, we'll get PI less than 1. When PI is equal to 1, means NPV will be 0. This is the decision criteria. Now, what is the difference between this NPV and PI? NPV is an absolute measure, whereas this profitability index is a relative measure. So, if you want to compare two projects having a different cash outlays, if cash outlays are same, NPV is better. But if the cash outlays of the projects are different, for example, two mutually exclusive projects are there, A project, B project, both are having the same cash outlay, then we can apply NPV. Suppose if the cash outlays are different for A project and B project, NPV is not. So this is all about profitability index. Now we'll come to the next called internal rate of return. This is another important discounted cash flow technique, just like NPV. This internal rate of return also takes into account the time value of money, discount the future cash inflows. So the internal rate of return is the rate of return which is earned on the project throughout the life. What is the average return which we are going to get from the project throughout its life? That is called IRR. In simple words, we can say IRR is that rate of discount at which the PV of cash inflow and PV of cash outflow both are equal. यानी IRR वो रेट है जहां पर प्रेजेंट वैल्यू ऑफ कैश इनफ्लो और प्रेजेंट वैल्यू ऑफ कैश आउटफ्लो दोनों इक्वल हो जाना. In other words, we can say IRR is that rate of discount at which the NPV will be zero. The net present value will be zero. So this is IRR. Now how to take the decision by calculating IRR? This IRR, after calculating internal rate of return, we compare the IRR with the required rate of return or the cost of capital. Cost of capital of the company. If the IRR happens to be more than the cost of capital, accept the project because the project return is higher than the cost. Whereas if the IRR is less than the cost of capital, reject the project. If IRR is equal to the cost of capital, indifferent. Like this, decision will be taken according to IRR. Now the procedure, how to compute the IRR. Now we have two types of problems, two models are there. The first model will be applied when the annual cash inflows are constant. If the annual cash inflows are constant, then we apply this procedure. Steps. The first step, we calculate the PVP. Step 1. These steps will be applied when annual cash inflows are constant. How to calculate IRR? The first step, we calculate PVP. Second, suppose the PVP happens to be 2.5. Second step, locate two discount factors in PV of annuity table. Locate two discount factors in PV of annuity table against the life of the project. Suppose project की life 5 साल है, तो 5th year के line में देखेंगे हमको दो values चाहिए. One value should be more than 2.5 and the other value should be less than 2.5. So two discount factors we are finding out from annuity table, PV of present value of annuity table. One value should be more than PVP, the other value should be less than PVP. So 2.5% we got. So one value should be more than 2.5, the other value should be less than 2. Example, at 15% it is 2.58 at 15%. At 16% it is, let it be, this is 2.48 and this is 2.59. 2.59. So 2.48 is less than 2.5 and 2.59 is greater than 2.5. So our IRR lies between 15 and 16%. One value should be more than 2.5, the other value should be less than 2.5. Now by interpolation formula, we can find out IRR. So IRR is equal to RL plus DFRL minus minus PB, payback period, divided by DFRL minus DFRH into delta R. This formula we apply. IRR is equal to RL plus DFRL minus PBP divided by DFRL minus DFRH into delta R. RL means lower rate of return. The lower rate of return is 15%. Lower rate of return is 15%. We take 15%. Then discount factor at a lower rate. The lower rate discount factor is, let it be 5.8. Here I will take 4.8. Lower rate discount factor is 2.58. So I have taken 2.58 here. Payback period. The payback period is 2.5. So minus 2.5. Divided by difference between these two factors. DFRL minus DFRH, दोनों का difference ले लेंगे into delta R, difference between the two rates. When we substitute the values, we'll get the IRR. This method will be used when the annual cash inflows are constant. While doing the problem, the concept will be more clear. Right now. Now second, if the cash inflows are not constant, then we have to apply the following steps. Step number 1, calculate fake PVP. Fake PVP, imaginary PVP, not real PVP. The formula for fake PVP is initial investment divided by average cash inflow. Actual PVP का formula है initial investment by constant cash inflow. Initial investment divided by constant cash inflow. लेकिन यहाँ पर fake PVP है, imaginary PVP है, तो denominator में average cash inflow. तो प्रॉब्लम में जो डिफरेंट कैश इनफ्लो दिया, फर्स्ट ईयर, सेकंड ईयर, थर्ड ईयर, फोर्थ ईयर, फिफ्थ ईयर, पूरों को टोटल कर लेंगे, उसको डिवाइड बाय 5 कर देंगे, एवरेज कैश इनफ्लो आ गया. Substitute initial investment by average cash inflow, will get fake PVP. Now second step, locate a discount factor in PV of annuity table. Locate a discount factor in PV of annuity table, a value nearest to fake PVP. Nearest to fake PVP. Suppose the fake PVP we got 2.5. 2.5 we got fake PVP, imaginary PVP. Now in PV of annuity table, against the life of the project 5 years, 5th year की लाइफ में देखते जाएंगे, कोई भी ऐसा वैल्यू चाहिए जो नियरेस्ट रहे ना 2.5 का. 2.5 के करीब वाला वैल्यू, चाहे वो कम रहा तो भी चलेगा, ज्यादा रहा तो भी चलेगा, बट नियरेस्ट. सपोज एट 15% it is 2.596. 2.596 is very near to 2.5. तो we begin our calculations at 15%. तो हम क्या करेंगे, 15% से we take the year cash inflow, PV factors at the rate of 15%, PV of cash inflow. So we are taking year cash inflows which are given in the problem, and this PV factors. PV factors we calculate at 15%. How to check the PV factors? You can refer the PV table, present value table, or you can use the simple calculator. By using simple calculator, we can find out the PV factors. So how to find out the PV factors with the help of simple calculator? The rate of discount is 15%. So simply divide 1 divided by 1.15. 1 divided by 1.15 is equal to, we got 0.8695. 0.8695. So I am rounding off to 0.86 or 87. 0.87 first year. Second year का चाहिए तो simply you press is equal to press कर लीजिए 0.4756. थर्ड ईयर के लिए चाहिए simply press is equal to आ जाएगा. बस is equal to press करते जाइए, 5th year, 6th year, 7th year, any number of years we get. This is for 15%. अगर 14% चाहिए तो 1 divided by 1.14. 10% चाहिए तो 1 divided by 1.10. So we get PV factors. Multiply the cash inflow with PV factor to get PV of cash inflow. Suppose the PV of cash inflow happens to be 1,08,500. 1,08,500 is the total PV of cash inflow, whereas cash outflow is given in the problem as 1 lakh. Problem में दे दिया 1 lakh rupees. Now PV of cash inflow is more. Actually IRR का definition ये है, cash inflow, cash outflow both should be same. But here it is not same. Outflow 1 lakh, inflow is 1,08,500. So to decrease the PV of cash inflow, we increase the rate. To decrease the PV of cash inflow, we increase the rate. We have taken at 15%. Now we take at 18%. Suppose PV factor at the rate of 18%. Again we calculate cash inflows, PV of cash inflows. We are calculating PV of cash inflows at 18%. Now total we got 99,000 suppose. So what we got? At 15% we got 1,08,500, which is more than cash outflow. At 18% we got 99,000. So our IRR lies between 15% and 18%. हमारा IRR 15 और 18% के बीच में IRR है, somewhere कहीं पर भी होगा. तो उसको इंटरपोलेशन फॉर्मूले से मालूम करेंगे. अब इंटरपोलेशन फॉर्मूला फॉर कैलकुलेटिंग IRR is the formula for calculating IRR by interpolation formula is IRR is equal to RL plus PVCF80 minus PVC divided by delta PV into delta R, where RL means lower rate. The lower rate is 15% plus PVCF80 on the present value of cash inflow at lower rate. What is the present value of cash inflow at lower rate? 1,08,500 minus PVC, PV of cash outflow divided by difference between the two cash inflows. दोनों कैश इनफ्लो का डिफरेंस ले लेंगे डिनोमिनेटर. Delta R, difference between the two rates, 15, 18, 3. About the terminal value method. This is the last method of discounted cash flow techniques. The last method of discounted cash flow techniques is terminal value method. This is an advanced method of evaluating capital budgeting proposals. In this method, the future cash inflows are reinvested in some other projects at a specified rate of return till the end of the project. So unlike NPV method, here in this method we find out the compounded value of cash inflows, and it is forwarded. Then we calculate the present value of compounded reinvested cash inflows with the present value of cash outflow. If the present value of compounded cash inflows is more than the cash outflow, then the project will be accepted. This is the criteria of terminal value method. The next is the NPV versus IRR debate. The NPV method, net present value method, and internal rate of return method, both are based on discounted cash flow technique in evaluating capital budgeting proposals. In many situations, both the criteria NPV and IRR will give the same result, but under certain situations it may be different. For example, in case of independent investment proposals, both will give the same results. For example, if the NPV accepts the proposal, then IRR will also accept. Similarly, if NPV rejects, IRR will also reject the proposal in case of independent investment proposals. But in case of mutually exclusive projects, the results may be different. In many situations, the results will be same. For example, if the project is a sound one, sound project means when the NPV is a positive value, more value, and IRR is also greater than the cost of capital or required rate of return. So for sound projects, what will happen? Both the results of NPV and IRR will be same. But only in case of mutually exclusive projects, it will be different. So in case of mutually exclusive, what is mutually exclusive project? Any one of the project has to be accepted. If A project is accepted, B should be rejected. Or if B accepted, A should be rejected. These are called mutually exclusive project. In mutually exclusive project, the IRR and NPV both will give contradictory results, different results. In other words, if NPV accepts, IRR may reject that project. If NPV rejects, IRR will accept the project. These are called contradictory results, and this may happen in case of mutually exclusive project. And why this controversy, why this debate will happen? One method is accepting, the other method is rejecting. It is based on some assumptions. In case of NPV, net present value method, it is assumed the cash inflows are reinvested at the rate of cost of capital. At the required rate of return, it is reinvested. Whereas in case of internal rate of return method, the implied assumption is the rate of return earned on the cash inflows is the internal rate of return. So based on this assumption, there is a difference of result. And apart from that, the results may be different on account of pattern of cash inflows and life of the projects, and also on the size of the investment. So these are the basis on which the two methods may give different results in case of mutually exclusive projects. Now next thing is approach for reconciliation. Approach for reconciliation between IRR method and NPV method. So the conflict arising in ranking of projects on the basis of NPV and IRR can be categorized into three bases. The first is time disparity, size disparity, and life disparity. Time disparity means the pattern of cash inflows of both the projects, of the different projects, may be different, Example, A project will give more returns in the initial years, whereas B project will give more returns in the later years. In this case, the pattern of cash inflows may be different. On account of this, the two methods will give different results. So how to resolve this? How to reconcile that? So under that circumstances, it is suggested to go for NPV. If there is a clash between IRR and NPV, better we support the NPV method, because NPV is consistent with the overall maximization of profit objective, maximization of wealth objective. So NPV criteria is consistent with the objective of the financial management. So we suggest to go for NPV. Similarly, the size disparity. The size disparity says the projects may have different cash outlay, initial investment, the present value of cash outflow may be different for both the projects. In that case, again, both the methods may give contradictory results. In that case, again, it is suggested to go for NPV because it is consistent with the objective of financial management. Last one is the life period, life disparity. In this life disparity also, the life of A project and B project may be different. That may give rise to contradictory results. Again, we depend on NPV method. So this shows how to reconcile whenever there is a clash between NPV and IRR method. The last topic is capital rationing. In a situation where we have unlimited funds available, then capital budgeting decision will become very easy, because we can accept all independent projects having a positive NPV or having a rate of return greater than the required rate of return. It's very easy because we have unlimited funds and easily we can select all the acceptable projects. But in real world, that situation will not arise. We won't have unlimited funds available. We have limited funds. Now there is a question, how to allocate these limited funds among the acceptable projects. We have so many acceptable projects, we cannot undertake all the projects. We have to shortlist the project, we have to ration the project. In that case, we give the ranking of all the projects. According to the ranking basis, we have to select the project, which project we should accept, and which project, even if it is better, we have to reject it because lack of funds. So this capital rationing will apply in a situation where there is a risk constraint on availability of funds. Constraint on the availability of funds, capital rationing technique will apply. In this technique, we have limited funds available, limited cash budget. With that limited cash budget, we have to accept only the better projects. We have to rank all the projects according to any of the criteria, NPV, IRR, PBP, or any criteria. After ranking the project, we select the first and second rank like that because we have limited cash constraint. So this is called capital rationing.